Hiya, George. Can you hear me?
Yes, sir. How are
Oh,
you?
thank you, thank you. I'm really well. Thank you so much for coming. Um, is the audio okay? You can hear me okay, yeah? Yeah, cool, cool, cool. I was like, it was a bit, it was not really clicking on before. Just want to double check because I was quite anxious about the sound quality. Hold on a second. Okay. Can you still hear me now?
Yes, I hear you.
Cool, 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 cool. Okay, thank you so much for coming. I don't know if anyone is going to come or not. I don't know, but I wanted to talk today about this kind of upcoming earnings season, and I wanted to talk about some kind of some do's and don'ts and stuff like that. Hi, hello. I'll just wait for Tomas. Can you hear us, Tomas? Can you hear us? Yeah, cool. Um, so I wanted to talk about earnings seasons, and I want to talk about some kind of do's and don'ts throughout the earnings season. I also, not to kind of put anyone on the spot, I'll ask you later on about this, but if there's any kind of things that you would like us to discuss on these Tuesday calls, uh, any topic that's kind of interesting to you, like if you could let me know so that I can kind of learn alongside you as well. I can kind of think about how to explain it. And I also go on this kind of journey and I try and learn myself and to become slightly better as an investor uh, as I go about, digesting that information, but also you really learn something when you're able to kind of teach it. So it's kind of like a two-way street for us that I kind of learn, and by me going off and learning, gives me an opportunity to also pass on my learning. So, yeah. So I'm going to talk about this earnings season. I used to be really fearful of earnings seasons because your stock reports and it's like it's like a bomb just went off. So it just kind of poof, everything just kind of goes into midair, and you had all these kind of notions of what should be and blah blah blah, and then when things just kind of hit the fan, you're kind of like, whoa, what is going on here? So I'm kind of trying my best to do the work in preparation for when that event happens. If you own a stock for, let's say, a year or 2 years or whatever, it's gonna happen at some point. That stock might be the third quarter, might be the first quarter. It's gonna have, it's a negative reaction at some point, and the stock is gonna be down 20% pre-market, and you're gonna be like, oh god, like what is going on? What are my kind of steps? It's not a pleasant moment by any stretch. So I kind of wanted to talk about. So I'm going to talk about kind of three things that are positive, and then like one thing like don't like a negative. So the first one, uh, kind of tying up to what I wrote about Alphabet just now. We as investors, we truly like stories, and we're just too drawn to a good story. And conversely, when the story has a bit of uncertainty, that uncertainty kind of feeds on itself, because when there's a bit of uncertainty, the outlook, you don't really know how things are going to turn out. There's some question marks. People's the valuations that people pay for that stock compress slightly. So the outlook is kind of fuzzy. The share price goes down. As the share price goes down, people ask more difficult questions, things that nobody was really thinking about beforehand. All of a sudden, it's like, oh, have you heard about that competitor in China? It's like always, not always, but often is the case. Oh, China. It's like this kind of dark cloud because nobody really knows much about it, but it's always there. And it's like, oh, there's that competitor that's doing like it's always something, right? And it's like we are kind of like so drawn towards having this straightforward narrative. And particularly, I find that it happens that a lot of these kind of newer businesses, like these software businesses, they like to be kind of clean stories. They like to have like pure play stories. They kind of like, oh, this is what we are, like we're cybersecurity, so something that's really easy, catchy. And when the story becomes a bit more unclear, all of a sudden it's like, oh, they're also doing hardware and the hardware billings wasn't very good. And it's like, that's going to happen. It's how it is. And I think that it's important to do the work on your business beforehand, so that when that happens, you're able to, within reason, have some peace of mind. So I believe the most important thing that you want to try and do is you want to try and cut back on the story and look at the fundamentals. Because, for example, Alphabet's at the top of my mind because I was just writing about it. But like in the case of Alphabet, it's kind of, it's quite a boring fundamentals. You kind of just grow a little bit each time, let's say about 10% more or less. But the share price is like all over the place. And I am trying to have some of these businesses in the portfolio that are quite boring, so that when everyone is like, oh my gosh, Ukraine or whatever other war might be happening in the background, you don't kind of want to be, like running around like a headless chicken. You want to kind of have some stability. You don't need every single position in the portfolio to be these kind of mega cap stocks. You don't need to like have just that. It's okay to have some kind of more enterprising businesses, but the premise is largely the same. You need to kind of do the work to understand the fundamentals, and you're trying your best to pick up businesses that are not going to have a lot of surprises in terms of the fundamentals, okay? So whenever you're buying a stock, it's a zero-sum game. And by that, I mean that you are buying a stock from somebody else, or you're selling a stock to somebody else. So it's kind of like a pari-mutuel system where you are both thinking that you kind of know more than the other person, but it's a zero sum because you're kind of buying and selling, and over a short period of time, that's going to net out. You're going to have some winners and some losers. But what I'm trying to instill in people is to have these two attributes, that you're cutting back from the stories and trying as much as possible to have some patience. And I talk about this quite frequently, that you want to kind of ease in to a business, and you want to ease out of the business if possible as well. So there's a kind of saying that a well-bought stock is already half sold. And this means that if you do the preparation, I always think, I don't know why, but I always think about like the marathon runners for the Olympics. Like on the day the person's going to show up to run, they know exactly the time. There's no question marks. They know kind of where they're going to go in the race. And yeah, there might be surprises along the way, but they've done 4 years of preparation for that morning, and there's not a lot of question marks left. They've done all the preparation, and then you just have to show up and do it, right? Americans call it execute, right? So you've done all the work, you've done all the preparation, so that you want to remove as much as possible of the distractions, because Wall Street loves a story. We love a story. And you notice that predominantly that certain businesses kind of have, even though if they're kind of like not very large cap businesses, they have more jazz around them. For example, Palantir, it's not that big a company, but they're always kind of over promotional, and they're always kind of like something's always happening to them. And then their market cap is like peanuts, like really. Nowadays, kind of jokingly, but like a small cap stock is something like, I don't know, like less than 4 billion. That's like small cap. And you compare something like that's like Alphabet is like $1.7 trillion, which is absolutely like, so like something like Palantir has so much more news flow than something like Alphabet, which, they don't even give you any guidance. They just tell you, oh, things are kind of looking okay. And, so my point is here is to try as much as possible to not get too allured by what the company is saying when things are bad or when things are good. Try to just focus down. Try not to get overwhelmed. And I often find that when I read a lot of earnings calls, and I often find that analysts like to kind of pick out something that often, not always, but often is not really that important, but because they kind of want to distinguish their service, their own analysis from someone else, they kind of want to add some kind of extra little nugget, which I'm not sure that it's always the case. It's difficult to generalize. Everyone's different and stuff like that. But the bulk of the bulk of what you need to focus on is really those financials. And I strongly believe you start at the balance sheet and kind of everything just comes from there. But if you have a strong balance sheet, you're not in a position where you kind of get anxious or nervous. You just don't want that. So that's about this being a zero-sum game. Now, the second point that I want to talk about is about sentiment. In the ideal scenario, you'd buy a stock when the sentiment is not great, and you would sell that stock when the sentiment is great. You'd be paying a low multiple, and you'd sell it at a higher multiple. But you can't control that, okay? You cannot control what the multiple is going to be next year. It's not possible. There are things that you can control. You can control when you buy the stock. You can control when you sell the stock. You can control how much you buy of that company. But you can't really control the multiples. So whenever possible, I believe that it's worthwhile to think about this 15% compounded annual growth rate. That's what I'm trying to do for the portfolio. And I'm trying to do it in a way that I'm selecting businesses that even if the multiple changes, the intrinsic value of the business is going to grow by approximately 15%. The problem is that sometimes the business is either decelerating because, just hit a rough patch or something like that, and you don't know if that deceleration is temporary or not, and that changes the multiple irrespective of the sentiment in the market. So that's difficult because if you pay for a too hyped up stock or story and it decelerates, then you kind of like, oh my gosh, when does it stop compressing the multiple? When, as an example, when I'm not picking on this company, but when Snowflake came out, everyone was like, oh my gosh, like Snowflake is going to just take over the planet. And there was so much hype over it. And, like most businesses, like I said this a few weeks ago, there's nothing in business that is a secular winner. Everything can have longer or shorter cycles, but it's a cycle. And they kind of came in a very good part of the business cycle, and now they kind of had a bit more of a difficult period, and their long-term trajectory is still gonna do okay, but because it goes through this kind of cycle and things kind of the comparables don't look as good, everyone's like, oh my gosh, like there's panic and this and that and the other. And when there's this kind of this, that, and the other, there's that uncertainty, the share price goes down, and everyone is like asking, the stock-based compensation, or everyone's like pointing their fingers at like, this, that, the other. So I think that when it comes to investing in your businesses, you try, if possible, to buy businesses that are quite stable, really. And I think that try, if possible, not to have all your portfolio with this kind of jazzy companies. It's okay to have 1, 2, depending on how diversified your portfolio is. That's fine, but just try to, as much as possible, to have different types of businesses that are reflecting other parts of the economy. Obviously, in the ideal scenario, everyone goes into, let's say, an asset-light business that doesn't require a lot of cash to grow. But often the case is that those asset-light businesses are really priced to perfection. That's the first problem. The second problem is these asset-light businesses, because they're so coveted, they end up having to hire out executives that are really, really expensive. So what starts off as an asset-light business, actually, compared to something like an oil company, isn't that asset-light, because the business is making so much free cash flow, but that's just going out the door to pay for those executives. Whereas if you're drilling for some oil in the Permian Basin, yes, you did have to put a lot of capital expenditure at the start to get that rig going, but then that's just spewing out cash. So which one is asset lighter? It's like, yeah, we kind of get these kind of SaaS businesses that everyone likes, but you have to kind of think about really what are the owner's earnings in this case, really, and the other thing as an extension of that is that I'm not picking on Snowflake, but just because it's top of my mind, you're looking at these businesses and a lot of that valuation that you're putting on is on the expectation that that business is going to grow for a really prolonged period of time undisrupted. And, technology is really difficult because it's undisrupted until it is. And then when it is, like, it just loses so much market share so quickly that it becomes really, really difficult. A few years ago, everyone was like, this was like just before COVID kind of kicked off. Everyone was in massive fear that Amazon was going to buy up loads of retail shops. There was that Whole Foods and things like that, and everyone was like, "Oh my God, they're going to just take over everything!" And like a lot of retailers on that day, Amazon said we're going to buy up Whole Foods. A lot of retailers just imploded on that day, and the story should have been that Amazon feels that there is money to be made to be closer to the customer, not only online, but in other ways, physically too. But that wasn't the story that people picked up from that. The story was like, Amazon's going to take over the planet Earth. And it's, again, that I'm trying to say, just like have some kind of sense, it's not always a story. And we're all guilty of that, we, since the dawn of time, like the Bible or whatever, like little stories, we love stories, Shakespeare, whatever, like we love stories, and that's how humans relate to the way we live. But it's important to, when you're trying to invest, to have some principles in place to look at the fundamentals of the business and trying to think, okay, if the business grows by approximately 15% next year, what should the free cash flow be? Try and think about the profitability of the business and what will the multiple be that I'm paying for that. If the multiple, is still really, really high, then perhaps, you shouldn't really be investing in that business. So a good rule of thumb, it's not mine that I invented, but, I like to think about this, is the Peter Lynch PEG ratio. He's looking at the growth in proportion to how much you're paying in the price to earnings. So if something is growing at approximately, let's say, 10 or 15%, and you pay, for example, 20 or let's say 25 times earnings, kind of that 1 to 2, that can kind of work. But if the business is growing at, let's say, 15% and you're paying, let's say, 45 times earnings, something's going to give. It's either the business is going to continue slowing down and that multiple is going to compress, or if you're very, 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 very lucky, that business will be something like Microsoft, where they can continue to buy up shares and they can continue to mop it up, so the earnings can continue to grow, even though the top line is not growing that fast. But Microsoft is an exception. It's an exceptional business, and not all businesses are the next Microsoft. Okay, so the other thing that I wanted to talk about is about if you're going to invest and you're going to and you notice that the company, so you made an investment and you had this expectation that over the next year the business is going to like grow. Let's say, for example, I'll use Alphabet because it's just top of my mind. I expect the business to grow, let's say, about 10% on the top line, and I noticed that for the next 2 quarters, the their revenues come in and let's say at 0%. So if you're gonna see that the business, what you had at the start, and then the company reports something and it's really out of odds with what you expected, I suggest if you're going to do something, do it quickly. So basically, if you're gonna have any doubts, you sell that business, because what you don't want, the thing you don't want is you don't want it to overwhelm your life. And you should have sold, and then you should have sold. And before you know it, it's like a year on, the stock is down 70%, and you've lost time, you've lost nerves, you've had cortisol over your body for like a year, and you end up selling anyway. So if you feel that the business that you own isn't really what you thought it was going to be, if you see that there's a misalignment there, just sell it straight away. You can always revisit a business later. There's no harm in doing that, just park it out for 6 months and see how it unfolds. In most instances, you will find that by cutting yourself from that, you're cutting what's called the endowment effect. And the endowment effect is if people have found that if they believe that something is theirs, they are much more closely attached to it than if it's not theirs. So an example is, like just a funny example, if you kind of, in an office or something, and you kind of lose your pen, and someone says, "Oh, here's my pen." And it's like, yeah, but I had my pen. Like, "Oh, where's my pen?" And it's like, a pen is a pen, but you have that kind of attachment to it. And the same with your businesses. You went through that process. You went through that decision of buying the business, and then the business doesn't work out how you thought it should be. That's fine. It's going to happen. It's part of the process. And you just might as well cut it right from the start rather than going on and on and on. So as I said before, with every type of business decision or investment decision, there's often a contra rule that you can kind of say, okay, you have all these rules in place, and then on this occasion you don't do this, and it's life, right? It's part of the process. So the way I think about it is like, if you allow me this analogy, is like when you're making a lasagna, you kind of get your premium meat and you end up cutting loads of the meat and you throw some of it in the bin, and it's like a waste, but that's the finished product. The finished product is like, you're only taking the best part of the meat and the best part of the dish. So in terms of investing, is like you make an investment and sometimes things are not going to work out. It's part of the process that some stocks don't work out, and that just, you have to come to terms with that. And you might as well, if you're going to act straight away. That does not mean that you make it your process of buying a stock. The next quarter, you dump the stock and then you buy another stock, and it's something irregular, and it's something that shouldn't happen. It's infrequent, but it has happened, and you need to just kind of take ownership of that and say, okay, it didn't work out. I said this before, and I'll just conclude this bit now, that for me personally, I believe in writing 3 decisions before you make an investment, so that you have some kind of perspective of what you're looking for. Because the last thing you want is all these kind of emotions and the cortisol, and the stock is down pre-market, and should I sell, and you're sweating and all this kind of stuff. You want to have all that work done beforehand, so that if things are not going the way you thought it was, you can recognize it. But if you have, let's say, 20 stocks and you haven't written them down, that process, you end up in a situation where you don't really know what was the story about, what was that company again, and why is it down, what's happening here. You don't want to be put in a position where you are not sure what's happening. So just write it down, and it doesn't need to be very long. I've said it before. It takes like 5-10 minutes to write down 3 bullet points, but I think that's really something that's quite helpful. So I'm just going to wrap it up here. I'm opening up to you guys for some questions and stuff. And while you're kind of thinking about some questions, also, I said at the start, I don't want to put you on the spot, but if you think about something that you'd like to talk about, in future calls, if it's something that you kind of think, oh, that's interesting. Why don't we talk about that? Like, I'm very open to it, and also to the members afterwards. The people that listen to the talk afterwards, you can also reach out to me. Speak, please.
Okay. Are you tempted ever to take a macro approach, let's say getting an ETF? For example, right now, airline stocks are all down. And you just say, you know what? This thing goes up when this thing goes down. And you know what? It's really down right now. Chances are it's going to go up. So you see what I'm saying? You ever tempted for this? Do you ever support this or what?
The one ETF that I strongly support is the S&P 500. I don't own it myself. My wife owns it via her pension fund. I think that is the best one because it's really difficult. We discussed this before in the past. This following the down and the up, it's really difficult because you buy it and there's no guarantee that you buy it, there's a dip, and 3 months later you're in the money and you're singing and dancing. It's difficult if you don't understand really, I find for myself at least, it's difficult if you don't understand what the business is trying to do. It's difficult to, in my opinion, to buy like that. Other people do other kinds of things, but I personally find it quite difficult because when you're making these macro calls, man, they're killer. For example, as an example, when I was recommending United States Steel, that is a macro call in a sense on steel production flourishing. But I tried my best within that macro call to buy the business that I felt had the best balance sheet. And it didn't work out as well as I hoped it did. It got bought out, but it didn't work out as well as I thought it did. But I knew what I was looking for. I was looking for the balance sheet to just remain stable. So that's a much easier call to make a call on that business, on that balance sheet, on, when it's I find, at least in my experience, when it's like an ETF, it can be like, man, we as investors in the last 10 years or so, we've become so accustomed to this dip and rip. It's like, it's been happening, man, like particularly over the last 5 years. Every dip has kind of had some kind of rip up, and there is no reason to expect that markets can't just go sideways for a really long time. There's no rule to say that. You look at, forget the US, you look at something like the British stock market. I know it's not as closely followed, but for 20 odd years, 22 approximately, and just one straight line, that's a really long time horizon. And we're not talking about, I know that people have jokes, but it's not some emerging country, the United Kingdom, it's a well-established country. And like, that's a really long time. Another example, you can look towards Japan, also a really long time where the market went nowhere. So I know now it's doing okay, but it can be, you want to align yourself in a way that you make an investment decision that within your holding period is likely to work out. That's really the key. Be honest about your holding period and what you can really stick around for. And that can be absolutely perfectly viable. And it is it is a good approach, but I personally have not gone on that route. What you're trying to do in investing is you want to try and perfect your style. So you may find, okay, you know what? I want to have 3 or 5% of my portfolio in various ETFs, and I'm going to go on this journey and become a better ETF investor because I find that's better for me because there's not as much volatility, and I know that in 2025 the airline industry will probably be back. So it can, that macro where there's less volatility, you're not getting timed out. For example, when you go with a shipping stock, for example, you can be timed out because the balance sheet is not particularly strong right now. The all the pricing of those tankers are falling through the floor, and you're getting timed out, and you don't want to be doing that. You want to be able to stick for the length of your holding period.
Thank you.
Got a few more minutes. Is anyone, Tomas, do you want to ask any questions? Don't have to.
Not for now, but you wanted some suggestions about what we can talk about later.
Yes.
So I think I might have written to you about diversification and how to approach diversification. That's a wonderful topic with no perfect answer, but we can all, I believe, share our
that's
ideas
a really
here.
good question. I'm going to try and talk about that particularly. That's a really good question. Thank you. I'll just briefly talk about diversification, where I think that is something that people don't really think about that much, but I think is really important, is how much exposure your businesses have to interest rates. And sometimes this people don't think about it. For example, let's say, if you're investing in something like Amazon as a growth business, it's a big, well-established growth business, and you're investing in some kind of smaller tech startup, you would have thought that they're not really comparable because one is $1 trillion and one is quite small, really. But these two often have quite a lot of exposure to the same factor, which is interest rates. So when it comes to building a portfolio, I have tried, in my experience, it's not particularly sexy, but I've tried to have some dividend stocks and some more kind of longer, like Enovix, which is no revenues. They don't make any revenues right now. So I'm trying to look at the two sides of the spectrum, some kind of really boring, slow growth, high dividend stocks. And then on the other side of the spectrum, something that is kind of more fast growing and is, has a more rosy future, because you don't want to be too conservative and on one side where you just all you have is dividend stocks, because the interest rates can change. They can also go down. I know that's a bet a lot of people are making, but you're trying to have exposure to different aspects of the interest rates. Does that kind of add some kind of... Definitely, I'm going to talk about this more. But yeah, this is something that I think is really important that people don't really think about, because I see a lot of investors that I'm invested, for example, I'm invested in Teladoc and I'm invested in Monday.com, and one is a healthcare business and one helps software developers build code. So it's kind of like they're not really related, but it's really down to a large extent the same factor. And another example that I saw during COVID was something like Wayfair, which they kind of sell merchandise like tables and stuff for the house. Their graph of Wayfair kind of went vertically up, side, and then down 2 years later. And you could pretty much superimpose on that block. They used to be called Square. And it was basically one is like payment solutions, and the other one is selling hardware. But the graphs are pretty much identical because they were exposed to the same factor. There was both kind of growth companies, and it's important to not think about what is the end customer, but like try and think about a little bit about that aspect about interest rate as well.
And another one, if I may suggest, it's about when to sell. But I'm particularly interested in one thing. Okay, there are lots of aspects to it, but I've had an impression that for the last, I believe, 20 years, everyone in the market, when buying, told, okay, don't buy at once, buy in portions, build your portfolio slowly. But still, when analysts in the market, majority of them talk about selling, it's very binary. So you either keep it or sell. While I find trimming my shares particularly useful, because let's say that sometimes there are binary events that undermine my investment thesis, and then, okay, I sell, but sometimes there are many question marks.
Yeah.
So I think you mentioned it today. So instead of wondering, oh, whether I should do it or not, perhaps I may have too many second thoughts to sell everything, but then I start just trimming the share in this position, and it's psychologically better because I feel I'm still leaving myself some chance to reevaluate that idea, but it's not like I'm keeping the initial exposure I'm not comfortable with. So
that's a really, really great question. And that's a much more difficult question to answer than diversification. So, as you said, there is no perfect way about this. John Templeton had a reasonably good record, and he had this very mechanical formula. He ran a trust fund in the US in around the 1960s or so. He's a very old guy. He died about 5-6 years ago or something. But yeah, so his way of investing was that when the stock had doubled, he would sell 50% and then he would just keep the rest. Now, his average holding period over that time was 6 years. Now, I don't think many people are willing to hold for 6 years. And I know that I'm not willing to hold for 6 years. So that's why I say, when it comes to buying, I believe that you want to try and spread it out at least, at the minimum, over a 90-day period, at the minimum. And similarly, I think it's worthwhile when selling, spread it over a 90-day period at the minimum. Now, I say that because the way that I'm trying to invest is I'm trying to, what is called, I'm trying to pick up the aspect of the story that's changing, okay? So again, about the stories. So I'm trying to buy, if possible, when I believe that there's a lot of kind of uncertainty. When there's a lot of uncertainty, people are unclear about the business's prospects. I'm trying to buy a stable, boring business that has a lot of question marks today. And my thesis is that over the next year or two, some of those question marks get removed. And I'm hoping that as those question marks get removed, there's more clarity, people will be willing to pay a premium. So there's two aspects to it. I'm hoping that my business's intrinsic value will grow by 10 or 15%. Business will grow by 10 or 15% over the next 2 years or so. But I'm also hoping, as a second aspect, that as people have fewer questions over the business, they may be a bigger premium willing to pay for my shares. So that's the way that I've tried to position myself, by buying things that people don't really want to buy right now, and hopefully things that are kind of... So what I'm looking for is for a business to go from mediocre to kind of, oh, that's kind of good. So that kind of mediocre to kind of, it's good, is a lot easier than to buy something that's gone from good to excellent. That's really difficult. That's what everyone wants to do, but I think that's really difficult. I think it's much easier to buy kind of just an average business and then kind of sell it when it kind of looks a bit better. I think that's a bit easier to do, and that's what I'm trying to do. But those two questions are really worth their weight in gold. I'm going to definitely talk about that next time, definitely. Okay, everyone, that's all we have time for today. Thank you so much for the questions, and like both of you, and thank you for coming. I'm off next week, but I'm here in 2 weeks' time. Okay? Thank you so much.
Thank you, Michael.
Thank you so much. See you soon. Bye-bye.